Okay, good morning, everybody. Let's just do a quick little microphone test. If you can hear me, just type into the chat box that the audio is coming through just fine. That way we'll know everything's working just fine before we get started here. And also let me know if you can see the image on your screen. It should say a slide that says, "What's your process?" Mauricio, if you're still on, I think I need another link for the question so I can see the questions that are coming in. I don't think I have that. Oh, here it is. I got it. I take that back. No, it says that feature is disabled. Interesting. Okay, now it looks as though it's working. Oh, there it is. Great, thank you. Perfect. Oh my God, so many windows. All right. All right, here we go. So everybody can see my screen. I'm assuming what you see on the screen right now is what's your process. That's that particular slide. If that's the case, we're in great shape. I'll refresh the page. Okay. Okay, how are we doing now? Okay, can everybody hear me? Please type in. Okay, sound and video are okay. All right, thank you, Mauricio. Okay, good morning, everybody. Dave Floyd here with Aspen Trading Group. This is the second installment of the ongoing weekly series I'll be doing here at 11 a.m. Eastern Time at FX Street. Again, thank you very much to Mauricio, Adinda, and of course all the other great people over at FX Street. I do appreciate them allowing me to spend 45 minutes or so with you each week. Last week, what we did, for those of you that were here, was kind of a look ahead to 2016, you know, kind of a big picture type webinar, not necessarily trade specific, at least in terms of the short term, but where my overall theme is going. And that is available online at FX Street, and you can go back and review that if you haven't seen it. And what I thought would be helpful today was to kind of go back a little bit, and for those of you that aren't familiar, provide a little bit of a framework to how I trade on a day-to-day basis. And it's not going to be a super detailed deep dive into my trading methodology, but it'll be enough to give you a sense of how I do it. That'll make further, or the subsequent webcasts that we do more helpful. You'll understand where I'm coming from, and over a period of time, you'll begin to see how I kind of look at the market. So obviously, you can do one of two things with the information that I'm going to give you today, and that's why I have this slide up here that says, "What's your process?" If you're a newer trader and you're still trying to explore things and trying to figure out what works for you, then maybe you don't have the answer to that question just yet, and that's okay. Maybe I can help you with that today. If you're a seasoned trader who's got a few years under their belt, or even many years under your belt, maybe there's a few things I talk about today that you may take a couple of pieces here and there and add them to your repertoire. Maybe they add a little bit of clarity on an area that you're struggling with, or you're just like, hey, that would be a really interesting facet to add. So what I'm going to go through today is basically a four-step process, kind of the big themes that I look at in terms of doing my trade analysis each day. But where I wanted to start was what I finished off with last week. Is I finished off with a little bit of a kind of a multi-day outlook. I gave the big 2016 outlook, And then I started talking about some individual currency pairs and looked at the S&P. So I just want to kind of go back and look at that as to where we are right now. So one of the things I talked about last week was the dollar index, and my overall belief is that the dollar index remains in an uptrend. But in the near term, prices were looking a little, corrective. And I would say that they are still largely doing that. Last week I had indicated, let's see if I can pull that up and get a bigger chart. Yeah, that looks better. On a short-term basis, this is on January 5th when we did the presentation. I was looking for prices to move a little bit lower from that January 5th high. And we have, in fact, done that. We traded down to around 98. So we traded a little bit lower than I thought we were going to, and we've since rebounded. But for the most part, I'm staying away from the dollar-based pairs right now. We just had a trade in dollar Swiss in the service, and we ended up taking a small loss on that because just not getting the follow-through either up or down that I'm looking for. So I want to probably focus more on the crosses, and we did a little bit of that with the crosses last week. We were really keen on the Euro Aussie dollar. I was looking to be buying pullbacks into the support zone. We did buy pullbacks. We got long at about 150 last week, and prices did in fact move higher. In fact, they moved to about a high of about, if I'm not mistaken, right around just over 158. So far exceeding what our target level was. We didn't catch the whole move, but we did catch a good chunk of it. That one is now pulling back, and I'm going to talk about that one a little bit later. That's very interesting on the possibly reestablishing long trades. And dollar Swiss, I'm not going to go into that. Pound Aussie is another one that I think is interesting, and I'll talk about that a little bit today as well. But I think the big thing that I talked about last week, or I didn't talk about it at length, but I'd indicated that I thought the S&Ps were in a bearish position. While the triangle count that you see here, and I'm going to talk about Elliott wave in a little bit, while the triangle count was not correct, the overall directional bias was correct. I was looking for prices to move lower. As we all know, the markets have been quite weak. We tested the 1900. In fact, we dipped below 1900. So we're in a position now where it's quite possible we could see a sustained period of weakness in the S&Ps. And again, towards the end of today's presentation, I'll bring you up to speed as to where prices are now. But I always want to start each week off with where we were last week and whether or not those forecasts generally played out or if they didn't play out. And regardless of what the outcome was, we need to talk about it, because if they did work out, let's find out why. If they didn't work out, let's also find out why, so that we hopefully don't repeat the same mistakes. Or maybe it wasn't a mistake at all. Maybe it was just simply the fact that the market didn't move in the direction you anticipated. Yes, you were wrong on the trade, but it doesn't mean you did anything wrong in terms of the analysis. So that being said, that was kind of a very brief overview of what I provided for you at the tail end of last week's presentation. So what's your process? And again, as I said, maybe you're just exploring that, and maybe I can inspire you and encourage you to start putting that process together today. Or if you're already a seasoned veteran, maybe I can add a few nuggets to your bag of tricks to help you become an even better trader. So the way I look, whoops, that wasn't what I wanted to do. There we go. So what I've done is I've come up with something what I call the 4 pillars for trading success. I know that sounds very Dale Carnegie and very salesy, but that's what you have to do in this day and age in order to kind of get yourself out there. It's not necessarily my personality, but Adam, guy who works closely with me in terms of marketing and in sales and all that, he says, yeah, you got to come up with something catchy. So I'm like, okay, how about this? And he goes, yeah, that'll work. But it is actually quite helpful, because what it ends up doing is it gives you a very simple framework for defining, or for allowing you to define, what constitutes a good trade setup. And let me just ask, kind of do a little bit of a poll as to the folks that are on the call here. Is there anybody on the call here? And again, there's no wrong or right answer, but I'm kind of curious, how many people on this call? And if you just want to type in, new trader, that would be great. I'm curious how many on this call are actually new traders, and they're really just kind of feeling their way. Anybody that doesn't answer, I'll assume is obviously somewhat more seasoned and has some good experience. but I would appreciate it if you could just kind of let me know where you stand within that. All right, well, nobody's responding, so I'm guessing that means that everybody on this call is, has a fair degree of experience. So regardless, let me share with you what I do on a day-to-day basis and see if it sparks some questions or adds a little clarity and insight to what you're already doing. So pillar number one, and I think this is where a lot of traders get tripped up. I think it's from a trading perspective, technicals usually tend to dominate, not the fundamental analysis, it's the technical analysis. So the first thing you have to ask yourself is there a valid technical pattern currently? And I know that's a very open-ended question because technical pattern, well, what constitutes a technical pattern? And of course, that depends on the trading approach that you have. Maybe you're an Elliott wave trader and a Fibonacci trader like me, or maybe you're a guy or a gal who trades based on RSIs or stochastics or candlesticks or whatever the case may be. But whatever that discipline is, within there, you're going to have to identify what constitutes a valid buy or a valid sell signal within the chart pattern. So that's the first thing you have to do. If you can't do that, steps 2, 3, and 4 are really of no value whatsoever. So if you've identified kind of a good solid trade setup, let's keep it real simple. In fact, I'll bring up an interesting chart. Let me go back on the slides here, and I'll give you a real world example here. Let me bring up a chart that I'm quite interested in here. So I'm going to share a different screen with you real quick. Just bear with me. Let me share screen number 2 with you. And you should now see a chart of the pound Aussie dollar. Is that correct? If you just want to type in that what you're seeing has now changed to a chart as opposed to a PowerPoint slide, that would be helpful. Okay, great. So, and again, this is in the context of how I view the market. It doesn't mean this is how you necessarily view the market, but I base my analysis from a technical standpoint on Elliott wave. And I always try to align myself with what the current trend is. The current trend, in my view, and on the Elliott wave view, is that we're in an uptrend. We've completed a correction down here around the December 31st low. We've moved up in 5 waves, and now we have a corrective pullback. From here, I expect the dominant trend, which is up, to resume. So for me, that's a valid technical pattern. That's step number 1. That checkbox is checked. It came into Fibonacci support. Prices are beginning to rally. We've got the early stages of a possible long entry in British pound Aussie dollar. So, in fact, let me just do this. This will make it a lot easier. I can bring over my chart real. This will make it easier for me to toggle back and forth. So is there a valid technical pattern currently? And I just identified that yes, there is. Oops. Pillar number 2, consider the fundamentals in the macroeconomic backdrop. Okay, so we're looking to get long the British pound versus the Aussie dollar. So the first 2 questions that come to mind for me there are, well, which of those currency pairs is likely to be weaker? Is the Aussie dollar going to be weaker than the British pound? Because if that's the case, British pound Aussie dollar will move higher. If the answer is the opposite, then it probably doesn't make a whole lot of sense for me to be long the British pound versus the Aussie dollar. The way I look at that question is by considering the fundamentals in the macro backdrop. The way I look at that is from the perspective of the S&Ps. The S&Ps right now are the dominant market, the dominant driver of what is moving prices, in my opinion. So if we have a weak S&Ps, which is what my forecast is, which currency pair is likely to be most negatively impacted by a weak S&P 500? Anybody care to answer that? I think the answer should be obvious, but let me ask it nonetheless. Somebody answered the yen. I'm asking in terms of British pound or Aussie dollar. Which of those two is going to be more susceptible to a weak S&Ps? Because I think the S&Ps are the driver of asset classes right now. Okay, well, in the interest of time, because we're getting not getting very many answers here. Aussie dollar is going to be the more risk-off currency. You know, if you have a weak S&Ps, that tends to drive the Aussie dollar lower, and the Aussie dollar has been weaker than the British pound, relatively speaking, over the last few weeks. So as a result, if we continue to see a weak S&Ps, which is what my forecast is overall, we're likely to see a resumption in this move of British pound, Aussie dollar. And that's in fact what we're starting to get at this point in time. So we go on to number 3. So we've checked both boxes. We've got number 1 and number 2 checked. In fact, let me give you another example. This is a historical example of how you can combine fundamentals and macro. This is from the beginning of 2014. And I was bullish dollar yen at that time. And the dollar yen at that time was trading in the low 100s. I think around 105, might have been 102. Okay, I'm back. I don't know what happened, but I lost connection to the Google Hangouts there momentarily, so I was assuming everybody can hear me. So assuming the microphone and the video is back in good shape, which I believe it is, dollar yen at that time was trading around 102, 105. I've got a chart that'll show that in just a second. But the technical pattern was valid. I thought that the dollar yen would continue to move higher. But then when you combine these data points that I was able to kind of ferret out from doing a lot of the reading and the research that I do on a day-to-day basis, I could make a very compelling case from a technical and a fundamental standpoint that dollar yen would trade higher towards 122 to 125. And if you look at the data points here, it's pretty simple. Again, it's one piece to the puzzle, but when you combine that with a positive technical pattern, it makes for a compelling reason to be long dollar yen. That makes sense to everybody? Here was the chart of dollar yen. This is when I issued that fundamental view or so to the clients, right around 105, longer term view, and we traded up to about 120 over the course of the year. So that's how you combine a technical and a macro backdrop. Pillar number 3, do related asset classes support your trade idea? So let's go back to this pound Aussie idea. And I've already kind of alluded to this, but again, it's something you need to check off your list. Do the related asset classes support your trade idea? Well, as I said, the S&Ps right now are what I would consider the primary driver of asset markets. You could also throw in their commodities, but weak commodities is also going to be more detrimental to the Aussie dollar than it is to the British pound, as are the weak S&Ps. It's going to be more felt by the Aussie dollar as opposed to the British pound. So again, related asset markets support the idea of being long the British pound versus the Aussie dollar. Now, here's the one part that is really completely up to you. I think it's really important to have an objective component to your trade selection process. And what do I mean by that? There's a whole variety of things that you could use. And I'm talking specifically about technical indicators. So you've got this idea, hey, this all makes sense. I want to be long the pound Aussie dollar. Okay, well, what are you going to base that on? You're going to base it on your technical pattern. You're going to base it on some indicators that are confirming what you see as the technical pattern. So what I would say is a good thing to do, and there's no wrong or right answer, it's what you're comfortable with, is maybe you're looking at a stochastic. Maybe you're looking at an hourly chart like I'm looking at right here. Prices have gone into a Fibonacci support zone, which is what I would consider an objective indicator combined with an oversold stochastic. And maybe you're going to start building a long position down here. Or maybe you're going to start looking at an RSI. Or maybe you're going to look at it waiting for a bullish engulfing candle. Whatever that objective measure is, something that's not subjective where you're kind of thinking, well, this is what I see happening and this supports that. That's subjective even though you're using some hard data. I'm talking about something objective, something that takes out a new high, takes out a new low, or some sort of a technical pattern like that. Just ignore my phone there in the background. Sorry about that. So for some people, it could be anything. It doesn't really matter, but it's what works for you. If you found that, you know, buying a moving average crossover is what works for you, then that's the objective part of the trade. So when you put all four of those pieces together, you'll get a really good sense of what is going to constitute a valid trade setup. Doesn't mean that all these trades are going to work, of course, but again, you're putting the odds in your favor. And that's what I think is the most important thing. And if you want, I have a link where you can download an expanded version of these four pillars. And I'm going to put that into the chat room here right now. Bear with me. You can download it. It's an extended version of these slides. And I just popped that into the chat. And it goes into a little bit more detail as to what I did on those slides. So what I want to do now is I'm going to do two things. One, I want to stop and pause and see if there's any questions as to what I just covered. Because again, I just give you a broad overview of what I look at in the market and how I assimilate the information and come up with ideas for trades. What I want to do now is answer any questions, and then I'm going to move on to what I'm seeing in the market currently and give everybody here a sense of what I'm going to be looking to do between now and next week. And then we'll report back as to what happened, and we'll go on to another topic. We'll probably go on to some other topics in terms of trading techniques, maybe a little bit on Elliott Wave, and I'm happy to do topics on whatever you folks would like to talk about. But I'll round out today over the next 10 or 15 minutes with questions, as well as a look ahead for some trades and some trade ideas that we can move on to. So I'll pause for just a second here, let you type in any questions you have on the presentation thus far, and then I'll move on to some possible trade setups. Okay. And let me just do one other thing here. Okay. All right, no questions regarding the overall presentation, and that's totally fine. What I'll do now is I'm going to go in and kind of provide an overview of where I see the markets going. These are some of the things that I talked about this morning with my clients in terms of technical setups and where I see the markets going. And one of the things we've been talking about is we're looking for some sort of a corrective rally in the S&Ps, and we've certainly got that. And the question now is whether or not that correction is over. And it looks as though it probably is. I knew, or I had a good feeling that this rally off of yesterday's low, and by the way, this is a weekly trend line coming off the 2011 lows. I was pretty sure that this was not the early stages, or not the completion of wave 4. And I actually did a whole blog post on that, and I'll share that link with you where I go into a little bit more detail because I think it would be helpful. And I'm going to put that into the screen here right now. Just give me 2 seconds. Pop that right in here. Because what I was looking for here was not just a simple correction to complete wave 4. Wave 4 probably had to have a little bit more of a complex correction. Now the question really becomes is, since we've rallied into some forecast support at the 1940 and prices failed, and now we have a little bit of overlap with this high right here at from this morning, from yesterday at 1923, I think it's a fair assumption that we're going to retest this weekly trend line and probably move lower from here. So I would say at minimum, where is my forecast? There we go. I would say at minimum, we're probably going to trade, if we start to move lower from here, I'd say we're probably going to trade down towards the 1828 level. And I don't think that is completely out of line at all in terms of the way the market's trading. The market's weak, without a doubt. The bounces have been feeble at best. So I think it's really quite possible, anywhere from 1860 all the way down to 1828. Now, again, what does that mean if you're an FX trader only? Anybody want to fathom a guess as to where you might want to be allocated if this forecast in the S&Ps plays out? Because to me, the S&Ps are going to be the driver, or one of the underlying drivers as to how FX markets move. And I can also think of one other stock that I'm looking to get short as a result of this as well. But anybody want to fathom a guess? And there's no wrong, I shouldn't say there's only one answer. There's several answers that would be correct. One of them I already provided, British pound, Aussie dollar. I think that will be a good currency cross to be long, but you're going to have to give it pretty wide stops. But this is how I see the S&Ps playing out. As long as we don't go back above 1980, which is the wave 1 low, as long as we stay below there, that's my objective kind of line in the sand. As long as we stay below 1980, I'll remain bearish the S&Ps for the time being. Pan answered the question with Aussie yen. Yes, Aussie yen would be a very good one to trade, albeit volatile, but it is certainly a risk-off currency. If you're going to be trading Aussie yen to the short side and you believe that the S&Ps are going to remain weak, then yes, Aussie yen would be a good one. You could also do dollar yen, euro yen, pound yen, Kiwi yen. Any of the yen crosses are going to be very susceptible to a weaker S&Ps. I think the Aussie dollar in and of itself will also be one that would be worth looking at. I'm not sure wave 4 is completed here yet, but it may very well be if it's completed here. Yeah, I have my doubts, but I think regardless, as long as prices stay below the 71.55 level, which is a fairly wide stop, I think in the hours and days ahead, We'll probably be heading down towards the 68.60 area. Actually, I think we'll probably go a little bit lower than that. Let's just assume that wave 4 was complete right there. I suspect we'll go probably down towards, 68.60 down to 67.68. That would be my forecast. Generally, I mean, forecasts change, but when you're looking to get into a trade, you want to come up with obviously a stop loss. You want to come up with a general price target area. And then depending on how the market unfolds, you revise that price target, or you fine tune, or you scale out of your trades as to whether or not the market's playing out the way you thought it would. Now, last week when I looked at Aussie dollar, I said we were probably going to head down towards the 69 level. And we did hit the 69. We've since bounced around, but I think there's another level lower for Aussie dollar. Question in the room there is it on this Aussie dollar saying you're assuming that wave 4 is over, and the answer is no. I'm not making that assumption yet, because, and this is where Elliott wave and I guess just trading in general can get tricky. If you read that blog post that I put up about the one titled "Not All Corrections Are Created Equal," that was the link that I just put in there. I provide an overview of how you want to look at corrections and how you can avoid not getting your stop losses tripped out at too early or too conservative of a level. So my answer is I don't know if wave 4 is complete, because if we go back to the S&Ps, which is what I'm going to be using as my barometer, I believe wave 4 is complete. But again, corrections can unfold in a variety of ways. I think right now it's safe to say wave 4 is complete because we've met the minimum price action objectives from an Elliott wave perspective. We've got an A, B, and C price. Wave 4 in terms of size and duration is relatively comparable to wave 2. Wave 4 unfolded a little bit more complex than wave 2, and that blog post will explain that to you. So if we have to make a decision, the S&Ps are telling us that wave 4 is complete. Is that the same case in the Aussie dollar? Well, it appears as though it's complete. 1, 2, 3 up, so that we could say that wave 4 is complete. The question is, do prices start unfolding in a series of 5 wave moves to the downside? But let's just make the assumption for the time being that wave 4 is complete. Let me get rid of this information right here. If we assume that wave 4 is complete, you have no choice but to put your stop loss just above the wave 4 high. I'm not sure that the wave 4 is complete in the Aussie dollar. Therefore, I think having my stop at 70.35, while that seems nice, meaning it's a tight stop loss, it could be a stop loss that might be a little bit impractical. I personally would still base my trade entry on a stop loss up here. So I would not go in with a full position here on Aussie dollar until we get a decisive break lower, because I still think it's possible we could fart around here in terms of a triangle or maybe even one leg higher. And if you put your stop loss right here, you're going to get dinged out. Prices will come up a little bit more. They'll stall, and then they'll roll over. That's the last thing you want to have happen as a trader. Same thing is said for the pound Aussie dollar. Is wave 2 complete here? Well, from just a very basic technical analysis standpoint, yeah, it seems like it. 3 waves down, A, B, and C into the projected fib support. Oversold stochastic seems pretty logical to me. If that's the case, and I want to be a buyer, my stop loss has to be at the end of this correction, so under 205.15, so about 120 pip stop loss. Again, that might be a little too tight. I don't know. The key for me, and this is how I differentiate the trades that I take versus the trades that I don't, is let's look at the short-term chart, short-term price action. Again, I apologize for the phone in the background. Should have muted that, but I didn't. We know that we've met some minimum downside objectives here. The question for me is, will this move unfold in 5 waves? If it does, that to me indicates that the correction is over, and I'm more than willing to ratchet that stop loss up to 205.19. Right now, we've only unfolded in 3 waves. So if we get a little bit of a pullback here and then we rally and make a 5-wave high, that to me adds a lot of conviction to being long. If we roll back over and take out the 206.04 before completing 5 waves up, then this 205.15 stop loss is irrelevant and it's way too tight, and it suggests that this wave 2 correction is not complete. Now, I know that's a lot of if-then statements. To me, it seems very clear because I've been doing this for so many years. But that, to me, is what I like about Elliott Wave. It provides a framework of being very objective. If this happens, I know my stop loss can be here. If this doesn't happen, then I know my stop loss has to be down here, and I still can't even contemplate a long entry because this correction is clearly not complete yet. So does that make sense? I know that's a lot of information to throw at you, but that's the reason we're going to be doing these webinars each week. It's going to be a slow, iterative learning process. I don't expect everybody to get everything all at once, but I at least want to share my ideas and what I'm seeing going on. If you don't understand exactly how I'm arriving at these conclusions just yet, that's okay. We'll slowly peel back those layers in the weeks ahead as we continue to do these. Question in the room here from Alex is, am I using fib levels to determine wave 3, or I would even say any wave termination point? And the answer is yes. In your question, Alex, wave 3 is always, not always, but typically 161.6% projection of the distance of wave 1. So what does that mean? That sounds like a lot of words and a lot of big words. What it means simply is this: we measure the length of wave 1, which we have as being complete, and then we project that from where wave 2 is complete. So we have to know that wave 2 is complete before we can know where wave 3 will terminate. So if we assume that wave 2 is complete here, we want to measure 161.6% from there. And that's going to give me a general idea of where prices may stop for wave 3. Now, the other thing is that they can also stop it at the 100% projection. So I would say at minimum, if we assume that wave 2 is in place here on pound Aussie, I would say the minimum upside is 2.1323, or more likely 2.1822. So if we assume that this is complete, meaning wave 2, we know our stop loss would be at 205, and we get long somewhere up around, let's say 207, something like that, or 206. That's a hell of a great risk reward, because we're risking a couple hundred pips at most to possibly pick up 500 to maybe even 1,000. Now, easier said than done. Pound Aussie moves around quite maniacally, as you are probably well aware. But from framing your trade expectation, those are good reward to risk trade-offs. Those are trades I'll be willing to take most of the time. So that's how I come up with the projections. The same thing can be said for wave 5. Wave 5 is a projection of using waves 1 through 3 projected from wave 4. You can also project it from wave 4, the value of wave 1. There's a variety of different ways, and then I can show you how we do these on a week-to-week basis, or we could just do a whole webinar some Tuesday on, using price projections to figure out your price target. There's many different ways we can go, because like any trading process, it can't be brain dumped onto you in a 1-hour webinar or even a 3 or 4 hour webinar. There's a lot of components that have to be kind of internalized and understood before you can really start putting it into practice. So that's why these weekly webinars will be very helpful, because we'll be able to build week in and week out, and you'll really start to get an idea of how I view the market and why I do the things that I do. Obviously, like any other trader, I'm not right all the time. I'm probably right about 60% of the time. So that's good, at least from a, win-loss ratio. Winners are typically larger than my losers, so that also works in my favor. But the fact of the matter is, you're going to be wrong 4 times out of 10, and that can be a little, it can be a little disconcerting for people to deal with. But that's the trading business. So we're pretty much at the end here. of this, if there's a couple of last minute questions, and I don't mean to leave it open-ended, I'm just providing you a framework as to where I see prices going in a couple of currency pairs over the next several days until we meet again next Tuesday. But I think it's helpful to give you a little sense of what I'm looking at and the reasoning and logic behind it. So if you've got some last minute questions, toss them into the board there. And if you don't, we'll just wrap it up. This will be recorded. I know Mauricio and the gang will provide the link when that's ready so that you can go back and review this if you need to. But type your questions in and we'll go from there. And the only other thing I'll leave you with as well, if you're interested in, if you like what you see here in terms of how I kind of think about the market and you want to see some of my research on a day-to-day basis, I'm going to type in a link here to take a trial. You're more than welcome to do that. Give me 2 seconds here. And there you go. Oh, perfect. Thanks, Adinda, for putting in the link for the recorded webinars. There was no other questions, so either I put everybody completely to sleep or my explanations were so spot on that it left no shadow of a doubt as to what you want to do as a trader. So I'm going to assume it was the latter, that the presentation was really so good. I hope I didn't bore everybody to tears, but you know, don't be afraid to ask questions. There are no silly questions when you're talking about something as, you know, deep and complex as trading. You know, there's not a simple process for any trader. It's a process that takes a lot of moving parts and, quite frankly, a lot of experience. And, you know, you're always learning, you're always adding new pieces to your approach. And since the markets are always changing, you too have to change. So some of this stuff can be hard at first, but again, if you stick with it, I mean, I've been doing this for 21 years now. Elliott Wave I've probably been doing for about 10 of those 20 years. So it served me well, and hopefully it will serve you well as well. All right. Thanks again for your time. Have a great afternoon or morning or wherever you happen to be located in the world, and I greatly appreciate it. Bye-bye now.